The options market can be a confusing place. Sorting through the daily avalanche of data, alerts, updates, articles, and analysis to find the most important information is an overwhelming prospect. But now you have help. Welcome to the Options News Rundown, the only program that breaks through the noise to bring you the most important news and information from the world of options. Every day, we bring you the top 5 option stories curated by the options experts at theoptionsinsider.com, the premier source for free options information. The Options News Rundown is brought to you by Market Taker Mentoring, the leader in option trader education. Get trader education, daily trade ideas, and more with a free 1-week trial of Market Taker Mentoring's live Advantage group coaching class by visiting markettaker.com/insider. And now it's time to break through the noise. It's time for your Options News Rundown.
Hello, traders. This is your Options News Rundown for Friday, July 13th. First up is a continuation of a story from yesterday. The U.S. economy is more vibrant than it has been in years, yet the bond market insists a recession could be on the horizon. Some market pros say that warning from the Treasury yield curve, which has long been viewed as reliable, is not as relevant as it once was because of the long years of central bank easing that had depressed interest rates and turned debt markets into far more placid arenas. The curve has been flattening by the day, meaning shorter and interest rates are rising faster than long-term rates, and they're growing closer together. A flattening curve is a warning about economic weakness ahead, but should the curve invert, where the short end yield, like the 2-year, is actually higher than the 10-year, that would be viewed as a very solid recession warning. On Friday, the gap between the 2-year yield and the 10-year yield narrowed to just 25.5 basis points, a new 11-year low. The inversion or flipping of the yield curve has certainly preceded recessions, but the timing of the onset has not been very consistent and has been as quick as a few months or as long as 2 years. Next up, we have some news from the Fed. U.S. economic growth has been solid during the first half of the year, and the Federal Reserve continues to expect to raise interest rates gradually, the central bank said on Friday in an upbeat semi-annual report to Congress. It's the Fed's second submission to lawmakers since Chairman Jerome Powell took the helm of the Fed early February. He is scheduled to answer questions on it before lawmakers next week. Details of the 63-page report were consistent with the Fed's current outlook, detailed at its policy meetings, which is that strong economic growth and low unemployment require rate rises, but that the lack of severe inflation pressures mean that they can remain gradual. The Fed said that the Trump administration's package of tax cuts had likely contributed to a rebound in consumer spending from a sluggish start to the year and will likely provide a moderate boost to economic growth this year. The relatively rosy picture of the U.S. economy was also referenced by Powell in an interview yesterday, in which he said he believes the U.S. economy remains in a really good place, with recent government tax and spending programs set to boost gross domestic product, perhaps for the next 3 years. The Fed has raised rates raised rates 7 times since it began a tightening cycle back in December 2015 and last lifted its benchmark lending rate by a 0.25 percentage point in mid-June. The Fed sees 2 other rate hikes by year end. Elsewhere in the report, policymakers once again flagged that wage growth has been weaker than they would have expected given the current unemployment rate of 4%. Although it did not weigh in heavily, the central bank made reference to the Trump administration's protectionist trade policies, saying that uncertainty was a concern to the financial markets. Let's finish up today with a story from Reuters. China's trade surplus with the United States swelled to a record in June as its overall exports grew at a solid pace, a result that could further inflame the bitter trade dispute with Washington. but signs that exporters were rushing shipments before tariffs went into effect in the first week of July suggest the spike in surplus was a one-off, with analysts expecting a less favorable trade balance for China in the coming months as duties on exports start to bite. The data came after the administration raised its stakes in its trade row with China on Tuesday, saying it would slap 10% tariffs on an extra $200 billion worth of Chinese imports, including numerous consumer items. China's trade surplus with the United States, which is at the center of the tariff hustle, widened to a record monthly high of just under $29 billion, up from $24.5 billion in May, according to Reuters calculations. That's all we have for today. You can find all of these stories and more on theoptionsinsider.com. Dan will be back next week with more options news you can use.
Thank you for listening to the Options News Rundown. To learn more about these stories or any other developments from the world of options, visit www.theoptionsinsider.com, the premier source for free options information. The Options News Rundown is brought to you by Market Taker Mentoring, the leader in option trader education. Get trader education, daily trade ideas, and more with a free one-week trial of Market Taker Mentoring's live Advantage group coaching class by visiting markettaker.com/insider.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.